Welcome and thank you for joining the first edition of our On Top of Tax webinar series for 2025. I'm Karen Riley, I'm a tax partner here in our tax assurance and risk management team, and I'm pleased to be your host for today's session. So today we're going to be sharing some key deadlines for you to be aware of, and in our usual format, we'll then be sharing a series of in-depth insights on hot tax topics. So next slide, please. So today I am joined by, first of all, Matthew Clark, who is a Customs and Excise International Trade Partner, who's going to be sharing a few key deadlines, then sharing an update on such matters, followed by Dawn Register, who's an experienced tax disputes resolution partner, who will be sharing an update on HMRC's new R&D Disclosure Facility, followed by Martin Callahan, who's a fellow partner in our tax assurance and risk management team, who will be sharing a few key CT compliance deadlines to begin with, but then is covering the new corporate duty to prevent fraud. And then finally, we have John Weston, who's an associate director in our employment taxes team, who will be sharing again some upcoming key deadlines before then discussing the importance of tax reporting on Christmas parties and other celebrations. We'll have the chance for Q&A later in the session, so please do feel free to drop your questions in the Q&A box. If we run out of time, please don't worry, we'll follow up with you afterwards. But you'll be able to see there at the bottom of your Zoom screen, there is a Q&A function. Please use the Q&A function rather than the chat function. We'll be monitoring the Q&A box for your questions. So we move on to the next slide, please. Okay, so just very briefly there, we've just run through our agenda already in introducing our speakers today. So I think we can kick off. Over to you, Matthew.
Thanks, Karen, and good morning or afternoon, everyone, depending where you're attending from. My name is Matthew Clark. I'm going to take you through a quick indirect tax, but a main focus on customs, excise and international trade as an update. Can I go on to the next slide, please? So key indirect tax compliance dates. We've got quarterly reported for CBAM, which is the Carbon Border Adjustment Model, CSOP and PPT, the plastic packaging tax. So the quarter end for December, those returns need to be done this month. VAT instalment payments for the annual accounts in the large schemes also need to be done by the 31st of January. And then you've got typical monthly quarter ends for 7th of Feb, and the VAT instalment payments that need to go in by the 28th of Feb for those within the annual accounts in a large business scheme. So if we move on to the next slide. So what I've done on the customs, excise and international trade dates, I've tried to pick out the really big ones. Now, this is not to say that all these dates will focus on all the changes that are happening this year, because I found over 20 to 30 changes. So you obviously need to go into the HMRC updates for your particular industry and just check this. But I've tried to pull out the main ones just to bring them to your attention on this webinar. So the first one is on the 1st of January. So we talk about the EU Carbon Border Adjustment Scheme. That is for certain products. When they're imported into the EU, you have to do CBAM carbon reporting. And that's in an effort to understand the carbon intensive nature of the products being imported into the EU. Now, as of the 1st of January, you now have to mandated use the EU calculation methodology. So for anyone that's filling out those returns, you have to do it in such a way that the EU now prescribe. What they allowed you to do previously was follow the calculation methods for the country that you're actually located in, but now you've got to use the EU one, so it's synchronized across all importers. There's also a registry that's been created within CBAM at an EU level for non-EU installations. So the production and manufacturing facilities overseas, they can actually register now and put information straight into the system. From the 31st of January, so the end of this month, safety and security declarations will be required on all EU imports coming into the UK. So this is normally something that your haulier or your customs broker will do on your behalf, but it is something just to note that they will have to do an extra step, an extra filing to bring all the EU goods into the UK now, and they might ask you for some additional information to do so. One of the other things that caught people out last year was the removal of the 999 license on customs declarations. And this is basically a catch-all declaration to say, I don't have any license in, and therefore I don't have any waivers for the goods to bring them in or out. Now, to get goods out of the country from the 31st of January, you'll have to make a specific license waiver due on your type of goods. And again, speak to your customs broker just to see if historically they've used the 999L license waiver for your export. And if they have, they'll need to start to use the specific license waiver for your goods to customs clear them out of the country. If that's not done and they don't know the correct answer to put the correct licensing code in, it will delay the exportation of your goods. So in the 1st of March, we've got one of really big shake-ups of the excise industry within the UK. So this is particularly for alcohol products. HMRC are utilising a new platform. It's going to be electronic submissions of returns. So it's just a new way of getting the information to them and the payments to them, and they're updating some of the rules as well. So if you are in the alcohol industry, hopefully you've started to see some of the notifications come out of HMRC to give you a heads up for that. But of course, if you've got any questions, please do get in touch and we can talk you through it. It's not really that there's anything particularly new. It's just that it's a new way of doing the same things. So that's the way that I'd look at this. But of course, getting used to submitting electronically when you're used to do it in paper or emailing can be quite difficult. So if we move on to the next slide, please. So 31st of March, we've got the full implementation of the green lane, the fast lane for the UK internal market for goods moving from GB into Northern Ireland, and the parcel UK carrier scheme is implemented as well. So that will affect you if you move goods over either in bulk or by parcel from GB into NI. 1st of April for the EU imports or any goods that you export and import into the EU market, they've got to now submit all their entry summary declarations via the new ICS2 system. So again, it's doing the same thing, but it's doing it in a slightly different way. So hauliers and brokers will need to get used to it. You might just want to check with them to say that they're ready and everything's fine. And then on the 31st of May, so covering the first 6 months of the year, the UK continental shelf, anything going on or off to and from the continental shelf, there'll be a new form for imports and exports. It's just something to make you aware of. So if we move on to the next slide. So we've got 2 slightly more in-depth slides to go through. The first one is what we're calling the Trump effect. And we are having a webinar at the back end of February. We'll publish the date on that with some key speakers from the US, the UK and the EU on how the Trump tariffs will affect international trade. Basically, though, I'm sure everyone's seen everything that's in the press. President-elect Trump, he's going to be inaugurated on the 20th of January. And one of the ways that he is going to make America great again and improve wages, national GDP, is to move more manufacturing back into the US, because he particularly doesn't like the way that businesses are manufacturing overseas and importing cheap goods to sell into the US market. In order to counteract that and encourage businesses to either make domestically within the US or to buy from countries that he feels are less in competition with the US home market, he is going to introduce additional tariffs. Now, he's done this before. He did this in his first presidency. So he does have form, let's say, for putting measures like this in place. So he has mooted that he will put an additional import tariff and set them at 10 to 20% for all goods from all countries imported into the US. So if your products go into the US market at the moment, they're subject to a rate of less than 10%. They could go up to 10 or even up to 20. He's focusing on 3 particular countries in terms of putting accelerated levels of tariffs on. One is Mexico. He's saying that he wants to increase the tariffs for all goods from Mexico by at least 25%, but they could go up to 75% or even 100% for vehicles or merchandise that's made in Mexico by a US company. So basically what he's trying to do is stop the US companies relocating to Mexico, where of course it's cheaper to make things because of lower labor costs. He wants them to relocate back into the US, and this is how he's going to push them to do it. Now, he's pledged the initial 25% increase just after his inauguration on the 20th of January. So we'll see if that happens next week. Similar for Canada. He said as well, 25%, again, pledged just after the 20th of January. There's lots of things mixed up in these. If you've seen the news, it's about, you know, illicit substances coming into the US, illegal immigrants coming into the US from these countries. There's lots of rationales behind it from the US government and President-elect Trump's camp. But really, the only thing we need to be aware of is, are these tariffs going to hit this month? Now, his big bugbear at the moment is with China. At the moment, we've got a 7.5% and 25% initial additional rates on certain products imported from China into the US. That's going to increase initially by 10%, so it'd be 17.5% and 35% respectively. But he's anticipated in the summer to increase that to between 60 to 100%. Now, that sounds a lot, but remembering some Chinese EV vehicles are already on 100% tariffs into the US market, and they're still imported and being sold for a profit. So I think the Chinese tariffs will definitely go through because there's bipartisan support for a tariff increase of that nature. So if we just move on to the last slide that I'm going to take you through. So this is just a quick kind of health warning from me, really. What we've noticed recently is HMRC taking a slightly different stance when they've raised a compliance visit or a query into an issue. So what they've started to do is to use a piece of legislation that was created for Brexit and basically say, once we find an issue or we notify you we're going to look into a particular area of your goods, then if we find something, we will assess you for it and we don't have to enable you to amend it. So whereas previously you might have been used to saying, okay, it's no harm, no foul, we'll go and amend our customs declaration to put it right. You don't need to raise an assessment. That typically used to be what happened. Now it's very much a, no, we found the issue, we're going to raise the assessment, and we may or may not let you amend your declaration to make the assessment go away, so you can put a reclaim request through. So it's just something there to say, I think people do need to take far more care on their compliance because you need to make sure that things aren't wrong now. Because whereas historically, if an officer found them, you'd be able to correct them and it wouldn't be a big issue for you. It looks now that the stance that HMRC is taking is, we will assess you first and we might not let you amend it. So if you don't get the right to amend, you won't be able to make the assessment go away. So it was just a bit of notionary caution from us to really think about that. It might be because of all the tax gap news you've seen in the press. It might be that Labour is looking as the new government to plug that gap, and therefore HMRC are being encouraged to be slightly more enforcive of their historical rules and not be as lenient as they used to be. It's all just conjecture at this point, but we have seen this change over the last 6 months. So on that point, I'm done, Karen. I'll pass over to Dawn. So Dawn, over to you.
Thanks, Matthew. Welcome, everybody, and thank you for joining the webinar. I'm going to give you a quick update on the research and development tax relief claims, which, if you're working in tax, you will be aware has been a rapidly changing landscape. So not only on the tax relief itself and the rules, which I'm not going to cover today, but actually HMRC's view of compliance and also the activity around inquiries, compliance checks and investigations. So this really is hot on the press. Off the press, we've shoehorned this into the presentation. HMRC press office woke up on New Year's Eve and decided to publish a new disclosure facility. Do let me know with a direct message if you know why it was launched on New Year's Eve. My working theory is that it had to be released in 2024 because actually there was a lot of discussion with the profession throughout 2024 about this disclosure facility, and it was launched the last day of the year, but there we go. So next slide, please. In terms of a bit of background, and if you're claiming R&D tax relief, you've probably been reading about this in the press, or if you're involved in a business or clients that are claiming it, then you are probably aware of this or involved in this already. But there has been a lot of pressure on HMRC, certainly post the moratorium on during the pandemic on compliance activity, to address error and fraud in R&D tax relief. The basis for that was work from the National Audit Office, who said that there was a larger than they would have expected, extent of errors and fraud in this area. Having said that, generally HMRC and the government noises are that qualifying businesses should still be claiming this. We want to encourage research and development in the UK compared to other countries. So underlying objectives of the tax relief haven't changed. I'm not going to go through all the activity. Again, for those of you in this space, you will be aware we've seen nudge letters. We've seen a huge increase. I mean, it feels like from 0 to 100, but probably around 20% of claims are now checked in terms of corporation tax inquiries. There's also been some selection of cases by the Fraud Investigation Service, which I tend to get involved with. There's also been some denials of claims right from day one, and there's certainly been withholding of refunds where businesses have applied for a refund. So there's been a huge amount of activity. But next slide, if I just give you the headlines of what the disclosure facility is, but then do contact us if you want more information or you think it's relevant, or actually you're struggling with an inquiry, which is where we are already helping a lot of businesses. So disclosure facilities are not new, just by way of background. In fact, I looked back, the first time HMRC used a disclosure facility was 18 years ago in 2007. So this is a model that they have used in other areas of tax to drive voluntary disclosures, and also just encourage businesses or individuals, so any taxpayers, to correct mistakes. The idea being that businesses should want to correct them voluntarily, and I'll come on to why in a second, but also largely agents or businesses do all the work for HMRC. So from HMRC's point of view, it makes sense. It's a low amount of work for them. They hopefully get errors corrected, money paid, or losses or refunds modified, and everybody goes off into the sunset. But it is a proven method of tackling compliance and correcting non-compliance. In terms of the particular aspects of this, I'm just going to highlight a few of them. I mean, the guidance is quite straightforward to read on gov.uk if you want to have a look at it. The ICAEW and the CIOT have put out a press release themselves, just encouraging people to get expert advice if they need it. I mean, the two areas you may need help on are a second opinion on your R&D if you're not sure about it, by a specialist. And then if you think you need to make a disclosure, a tax dispute specialist like myself or other members of our team. So it has a defined start and a defined end. As I said, you have to do a lot of the work, or your agent has to do a lot of the work. Recalculation of tax, recalculation of what the qualifying expenditure and the actual R&D claim should have been. You need to calculate late payment interest and then consider your penalty position. If there's a risk of fraud, if you've got other errors outside of R&D tax relief, this is not suitable. If you've already got an inquiry, this is not suitable. If you need time to pay, that's potentially possible, which actually I think is a positive about this facility. And the only thing that's a slight tweak is there's no notification process. And again, most businesses who need to make a disclosure need to get on with it and not have any delay. So that's a slight concern. Why would anybody want to come forward voluntarily? Just in the last few minutes, if you need a clean bill of health because you're going to sell your business, you're going to fundraise, if you want the lowest penalty, then unprompted, i.e. voluntary, is the way to achieve that. And I think that's possibly all, Karen, but we do have some questions at the end. So thank you.
Thanks very much, Dawn. And next we have Martin Callahan talking about the duty to prevent fraud.
Great, perfect. Thanks very much, Karen. Hi, everyone. So I'm a partner in the tax assurance and risk management team, along with Karen, and all of our works relates to good tax governance and risk management, including compliance with legislation such as Senior Accounting Officer requirement to publish a tax strategy, I'm also part of the team that advises on the prevention of economic crime. So if we bring those two elements together, we've done lots of work on the failure to prevent facilitation of tax evasion legislation, which you'll may be aware of as the CCO legislation. And we're now additionally turning our attention to the failure to prevent fraud legislation introduced by the Economic Crime and Corporate Transparency Act 2023. More on that very shortly, but first, a summary of some of the upcoming reporting and compliance deadlines for the quarter. So the first there, end of this month, under the Platform Operators Due Diligence and Reporting Requirements Regulations of 2023, platform operators, those effectively who connect buyers and sellers online, have an obligation to notify HMRC that they are a reporting platform operator, and also to identify their reportable sellers and collect and report relevant information to HMRC. And I said the deadline for that is 31st of January. For those companies with a March year end, it's that time to start reviewing your 2-year claims and elections. In March, 14th of March, for December and March year ends, very large companies have a requirement to make payments under the very large company quarterly instalment payment regime. And very close to my heart, the SAO filing deadline at the end of March. So an SAO notification and certificates need to be filed in respect of year end 30th of June 2024 for limited companies and 30th of September 2024 for PLCs. And those businesses within the requirement to publish their tax strategies must publish those tax strategies in respect of year ended 31 March 2025 by the 31st of March 2025. And so we move on to the next slide, please, and back to the fraud agenda. Well, the prevention of fraud is on the agenda for a number of stakeholders, clearly. It's both costly and disruptive for businesses and government. And it's estimated that the average organisation loses 5% of its annual revenue to fraud. And HMRC statistics on the tax gap indicate that tax evasion and the hidden economy combined make up 20% of the 35.8 billion considered to be lost to the Treasury each year. And as some additional context, now clearly the investigation of fraud is costly and time consuming, and by its very nature actually too late. The fraud has already happened. And until now, it's been difficult to prosecute corporate liability. So historically, to establish corporate liability for fraud required a direct link between the underlying fraud offence and the directing mind and will of the organisation, effectively the board of directors. But the failure to prevent fraud legislation makes a prosecution far easier. And on to the next slide, please. So as I said, the purpose of Section 199, Economic Crime and Corporate Transparency Act, is to make it easier to prosecute corporates where they fail to prevent fraud, where that fraud is committed by an associated person of the corporate. An associated person is defined fairly broadly, and where there is intended to be some benefit for the corporate or any person to whom the corporate provides services. So if an associated person of a business were, for example, to file a fraudulent tax return and that benefited the corporate potentially could be prosecuted under this new piece of legislation. And the legislation is modelled very closely on Bribery Act 2010 and also the CCO legislation, and it has effectively the same principles. It provides for corporate criminal liability in the if there were to be a successful prosecution, it would result in an unlimited financial penalty, but there is a defence, and the defence rests upon having reasonable prevention procedures which are based upon 6 guiding principles, What do those principles look like? Well, actually, they look very similar to the principles under Bribery Act and the CCO legislation, but helpfully, Home Office guidance was issued in November last year concerning the new offence, with the legislation to take effect from the 1st of September 2025. And if we move on to the next slide, then I will talk through what the defence looks like, the 6 principles. Well, as I said, the 6 principles there are the same as for CCO and Bribery Act. So anyone on this webinar who has an awareness of CCO and Bribery Act fundamentally has an awareness of what the defence should look like. And those 6 principles extend from risk assessment, demonstrating top-level commitment, carrying out appropriate due diligence on associated persons, making sure that the controls that you have in place are proportionate and reasonable when considering the risk. So to a degree, that will be judged by the results of the risk assessment. There is a requirement to communicate, and this will be to demonstrate top-level commitment, and also training to communicate externally, make very clear zero tolerance for fraud, but also internally, ensuring that there's an appropriate level of training within the business. And finally, this can't just be a one-off exercise. There's a requirement, in common with all risk management, to monitor and review risks, which could include areas such as whistleblowing and escalation. And then if we move on to the next slide, the key question here, why am I talking about the failure to prevent fraud as part of an On Top of Tax webinar? Well, I alluded to this earlier, that tax fraud potentially does fall within the scope of this piece of legislation. So the underlying fraud offences are listed within the legislation, and those include cheating the public revenue. So as a consequence, tax fraud does fall within the scope of the underlying offences. So to repeat, if an associated person of a corporate carries out tax fraud which benefits the corporate could be prosecuted for failing to prevent the fraud from having taken place. Now, there's very clear overlap here between the failure to prevent fraud legislation and also Part 3 Criminal Finances Act, the CCO legislation. And we're aware that HMRC were consulted in drawing up the guidance I mentioned earlier. But it's important to remember that although the legislation is similar, it's not identical. And one of the points made within the guidance is that having a defence under one piece of legislation doesn't necessarily mean that you have a defence under both bits of legislation. It's also important to bear in mind that the failure to prevent fraud is aimed at the prevention of an associated person committing fraud for the benefit of the business, while CCO is aimed at the prevention of an associated person facilitating tax fraud on the part of another. So very similar, but different. And there are some nuances, there are some nuances in the legislation around the size of business to which the legislation applies, and also some of the definitions, such as the definition of associated person. Under the failure to prevent fraud legislation, subsidiary companies are automatically associated persons of their parent, whereas under the CCO legislation, that's not necessarily going to be the case. You have to look at the specific services that are being provided by that subsidiary for its parent. And so what are businesses doing about this? If we move on to the final slide, well, it's clear this piece of legislation is prompting businesses to refresh and refocus on CCO, as well as taking steps to comply with the new legislation. So what are the immediate actions that we're seeing? What should be borne in mind when looking at the actions to take place? Firstly, underlying this new piece of legislation, the CCO legislation and the Bribery Act, it's key that a risk assessment is carried out. When looking back at the CCO legislation, HMRC were very clear that if a business hasn't taken step to consider the potential risk for the business or the controls that are in place, it would be difficult for it to prove that it had reasonable prevention procedures in place. That risk assessment must take place. It must be appropriate for the size and complexity of the business. It's important to ensure that those controls that are in place, the mitigating controls, are tested. This is something that we're seeing being carried out by internal audit functions. It's important that an appropriate level of training is rolled out within an organisation. And finally, as I said before, it's key that risks are monitored and reviewed, that some form of review is taken on a periodic basis. We would typically expect that to be carried out every year or every 2 years. And so ultimately, if we think back to the cost of fraud to UK businesses, the steps that I've mentioned now, so this isn't just about the purpose of meeting the requirements of the legislation, it's also good for business. Having those controls in place will ensure that there is a defence in place, but ultimately will also protect the business from being a victim of fraud. And now on to John.
Thanks very much, Martin, and good morning, everyone. My name's John Weston, and I look after all things sort of employment tax related. And following Christmas revelry, it falls to me to talk about tidying up on the tax front. But firstly, next slide, please. As with everybody else, a quick reminder on some upcoming deadlines. And from the employment taxes front, there's some more familiar ones there and some perhaps slightly more esoteric. Of course, 19th of January, we've got the ordinary monthly RTI payment. 31st of January, I don't know if you do have, but if you've got any unapproved, unregistered pension schemes that you started in 23-24, then you need to tell HMRC about those before the 31st of January. 2nd of February, the usual P46 car report, if anything's changed there in terms of your provision of company cars. And 5th of February, if you are providing workers onto an end client and you're not operating PAYE, you're an employment intermediary, you'll have a quarterly report that will need to go into HMRC as well. Next slide, please. And we'll return here to my main theme of tax reporting around celebrations. And I have a short agenda for the purpose, you'll be pleased to hear. Firstly, I want to address why now, which seems like a reasonable question. I mean, couldn't we do this later? And assuming that I have a reasonable answer for that, then we'll have a look at what I'm saying we should think about. Next slide, please. So the why now question. Well, simply, post-Christmas, of course, bills are coming in for those events. It's a good time for collating records, annotating them with the appropriate detail, and making any inquiries of budget holders. In my experience, some of these expenses come in across a whole load of budgets and codes in all kinds of different ways. If we can track these while memories are fresh, then that is all to the good. Remember, the burden of proof is on the employer to demonstrate that an exemption applies. And they can only do that with appropriate documentation. So reviewing the tax treatment now rather than just ahead of the P11D or the PAYE settlement agreement filing season is a lot less fraught and likely going to be a lot more accurate. In answer to the question, is this an issue in practice? Yes, HMRC do check whether entertainment costs have been treated incorrectly. And specifically whether the conditions for exemptions, typically the annual party exemption or the trivial benefits exemption, have been met rather. And I mentioned just now about PAYE settlement agreements, PSAs. If you do have costs that don't qualify for an exemption, and we're going to come on to those, you need to think about how they will be reported. If you do want them to go through a PSA, and we'll come on to those later, and you haven't got one, or it doesn't cover those costs, you will need to sort that out with HMRC by the 5th of July of this year. So, next slide, please. Let's talk exemptions. And it's worth just mentioning the basic conditions around the exemption for annual parties and social events, because, of course, this is relevant not just to Christmas, but any annual event, so relevant for the year ahead as well. I put up just some of the main conditions there. Needs to be available to all of those who are at a specific location or site. It needs, of course, to be annual. It only applies up to £150 per head. This is not an allowance, it's an exemption. So if you spend £170 per head, none of it's going to qualify. It does still apply to virtual functions. That's a bit of a legacy of the COVID era, but that's still there. And don't forget that you're collating costs from all over the place, as I say, which have got to be VAT inclusive. That could include the cost of taxis for getting your employees to and from the event, and all of those kind of ancillary costs need to be taken into account. And finally, as I say, it's not an exemption just for Christmas. It could apply to a number of events over the course of the year. If you are looking to apply to it to more than one event, then do bear in mind that we still have this £150 per head cap. So you need to apply it to the event which is going to use that most effectively. So if you've got one at £130 and one at £80, obviously you want to apply it to the £130, but you can't bring the two together because then you're going to go above the £150 cap. So moving on, let's have a look at the other exemption which is typically used. We're talking here about trivial benefits. It's an exemption which is sometimes misapplied in my experience. It covers gifts up to £50, VAT of course inclusive again, and this is an exemption separate from the annual party, so you might want to make sure that you strip out anything that you want to claim under this exemption from any of your annual party costs. It can't be cash, it can't be cash vouchers, it has to be something tangible, and it has to be something which is not contractual or otherwise given in respect to the duties of an employee. I don't know if I'm being pedantic here, but usually I sort of suggest to people that they accompany the gift by a simple messaging, sort of, compliments of the season, happy Christmas, or whatever it is, rather than, thanks and well done for a job. Thanks and congratulations for a job well done over the course of the year, which might fall foul of that particular condition. And then finally, this is something that HMRC are quite hot on. It doesn't apply to reimbursed expenses, which can be a bit of a tricky one, really. So what we are saying here is that in order to qualify, the cost has to be incurred directly by the employer. So if you have an employee who goes out and bears the cost and is then later reimbursed for them, that doesn't qualify. In HMRC's book, what's happening then is that the employee is receiving a cash payment, which strictly should go through PAYE and NI. So something to look out and be cautious about there. Let's move on, and I think we may have a poll for you. HMRC do produce some guidance on the trivial benefits exemption and what does and doesn't qualify. Here's an example. I'll give you as long as it takes me to eat a cream cake, which isn't long. Well, I think I would have consumed a few cream cakes by now, so I don't know if we've got any results through. Yeah, fairly even split actually. 53% say yes, 39% no, and 8% are hedging their bets. As I say, this is a real live HMRC example. It is included in their guidance. I think it was back in December 2019. They say that quite possibly, no, this does not qualify for a trivial benefit, which might amuse you or perplex you accordingly. The reason being, they say that if your employees are in the habit of expecting a cream cake every Friday on a regular basis, you may well have formed a legitimate expectation. And that, in their mind, is akin to almost a contractual right, and therefore it wouldn't qualify. I can't say I necessarily agree with that interpretation, but there you go. It does just illustrate how difficult it can be to interpret HMRC's position with regard to this exemption. With that, let's move on again and consider the position if we can't take the benefit of either the annual parties or the trivial benefit exemption. Unless you have a payrolling agreement with HMRC, you're going to be reporting these benefits then on a P11D before the 6th of July, or perhaps more likely through a PAYE settlement agreement, to say a PSA, before the 19th of October following the year end. I put up there so the sort of respective considerations behind P11D reporting and PSA reporting. Generally speaking, we're talking about PSAs. I mean, they are expensive for the employer because you have to gross up the tax, gross up for the tax, which the employer is then going to pay on behalf of the employee. But that does, of course, produce a happy employee. And there is a bit of a cash flow benefit in so much as the tax and the NIC is not going to be accounted for before the 19th of October. But if we don't, as I said before, have a PSA in place, or it doesn't include staff in entertaining, we need to be telling HMRC about this before the 6th of July in order that we can make sure that we are appropriately covered. Thank you. I'll move on to my final slide for today. Religious festivals or the celebrations do, of course, happen throughout the year. And I throw the following in just as a final thought. As I say, we need to consider whether exemptions apply, and annual events and trivial benefits, bit like dogs, they're not just for Christmas. We can use them throughout the year, and we need to be awake to them. And finally, I don't want to go off at too much of a tangent, but because I do get asked quite a lot about off-site events generally, I would suggest that we keep in mind that an event which is celebratory in mood might still have a fundamental business purpose. And if that purpose is clear and employees are required to attend as a necessary part of their duties of employment, it may not give rise to a benefit, or at least one that can be proportionately reduced. For example, I'm thinking here about the annual business conference or various training courses, etc. You've got to tread with care. However, HMRC do review costs, and events which are badged as training or business conferences but are in the nature of an incentive or a reward will still be challenged. But some planning can be really useful here. Review the content of the event up front, what it aims to achieve, how it's going to benefit employees. Think about where it's going to be held. For instance, if you're organising an overseas conference for UK-based employees, that's obviously going to be more likely to be challenged by HMRC. Think about those additional costs which have been provided in respect of the entertainment element and the added enjoyment. Can they be apportioned? Are they marginal costs? Would they be incurred anyway? Those are also factors to take into account when quantifying any benefit. And liaise with suppliers, hotels or conference providers. Appropriate invoicing can be useful. So if those costs are allocated in a just and reasonable way, again, it might be possible to produce a conducive result from a tax perspective. Anyway, that's it from me, and I believe we're now moving on to questions and answers.
Thanks very much, John. Well, actually, if it's okay, I'm going to start with you, John, because there's a couple of questions just come in whilst you have been sharing your updates and insights. So the first one, you referred earlier in your update to a £150 cap. The question that's come in is, does the £150 cap need to include accommodation as well as party costs, i.e. if teams are spread around the country and some have to stay over to attend?
Yes, it does. Yes, it does. So we are having to bring into account all of those costs. That would include the costs of accommodation, the hotel, or wherever it is that you're putting on the event.
Perfect. And then the second question that's just come in for you as well is, do we still need to split out the input VAT on Christmas parties for employees and partners, brackets guests?
For For my purposes, for computing the benefit, we are looking at the costs per head, inclusive of VAT for all of the attendees. Yes, we're going to be bringing into account all of those costs.
Great, thank you. Please do have a think about your questions and pop them in the Q&A for us. I have a couple of questions for our speakers, actually, just listening to the content today. So I'll maybe run through a couple of those just whilst people are thinking about informing their questions. I'm going to go back to Matthew to begin with. Just hearing what you were talking around the changes in approach that you're seeing from HMRC and maybe going down that assessment route. If you have a scenario, say, whereby a business operates inward processing relief for materials that are imported for manufacturing goods that are then subsequently exported, if HMRC hasn't carried out any checks since authorising relief, and if the business is submitting returns as normal and HMRC hasn't raised any questions, does that imply that things are okay?
No, unfortunately not, Karen. I think that's the impression that an awful lot of businesses get, which is no news is good news. Sometimes when HMRC are concerned. But typically, what I've seen in the past is that when officers do eventually come out and look at businesses, they go back for the full 3-year assessment period, which is what we work with from a customs and excise perspective. It's 4 for excise, but imports and exports, it's 3. And they'll just look at the records for the past 3 years. So even if you've been submitting like quarterly bills of discharge for inward processing, so all your returns have been submitted compliantly and your paperwork's up to date and everything, it doesn't mean that they're not potentially going to find any errors. And if they find those errors first, then obviously it's at their discretion whether they let you amend your records so you don't get an assessment raised. And I had that exact situation with the client in September, where the HMRC officer had said, we're coming in to look at your inward processing accounting. And they came in and they found a mistake that ran back by 18 months. And we came to an agreement with the officer, but not everything could be amended. So we kind of reduced the assessment, but they still ended up with, over £500,000 payment that needed to go over to HMRC. So it was an unexpected cost. And the main thing for me was that they'd never taken a chance to get a party such as ourselves to come in, an external advisor, and just kick the tires on what they were doing. Are you doing it right? Is it compliant? Is there any best practice that you could put in place to make it even better? How should you be signing it off from a management check and accounting perspective? So it's just things like that for me where, compliance is becoming more and more important in a customs world now, because if you're no longer able to go back and fix your mistakes once an officer finds it first, it could be a very costly mistake. Whereas historically, as a business, as I said before, when it was prevented, you might be used to being able to correct it and it's no harm, no foul. It doesn't seem to be going that way anymore.
Okay, that's really interesting. Thank you. I can see some more questions coming through, so thank you very much. I'm going to go to Martin next, actually. We've got a question on the failure to prevent fraud provision. So there's a question that's come in that says, for the new fraud provisions, practically assume businesses expected to produce completely separate risk assessments to such as CCO, or is there a way to combine them?
Yeah, I mean, I think the first thing to say is yes, they are separate bits of legislation. There are nuances to the legislation that look quite different, but fundamentally, there are 3 bits of legislation that all follow the same failure to prevent principles. And so in an ideal world, the approach would be to take an holistic approach, because there are going to be areas of crossover. There are going to be areas of common risk between the different bits of legislation, and also common controls. So fundamentally, under CCO, under ECTA, you need to carry out a risk assessment. Now, the way you do that isn't prescribed, and I think that it's up to the business to decide where they focus their attention. But you could do a piece of work, I suggest, that covers both areas.
Just I suppose a tag-on question to that. I mean, do you think that the failure to prevent is likely to prompt businesses to revisit their CCO risk assessment? I mean, what's HMRC expecting here?
Yeah, I mean, I think absolutely that will be the expectation. So we know for a fact that HMRC were involved in drawing up the guidance under the new piece of legislation. And the new piece of legislation does so, while the guidance says that a company could be prosecuted under either or both bits of legislation in respect of a particular scenario. And an investigation that starts under, for example, Economic Crime Corporate Transparency Act could theoretically lead ultimately to a prosecution under CCO. And there's some very clear elements within the ECTA guidance that I think carry across to all of the failure to prevent pieces of legislation about the requirement to carry out the risk assessment, but also the importance of refreshing that risk assessment on a regular basis and also monitoring and reviewing risk.
Great, thank you. Sarah, I hope that answers your question. Thank you very much for sharing that one. There's a couple of more queries that I'd like to go back to John on, but I do have a question that I'd really like to ask Dawn as well. So John, just a couple more employment taxes related queries, a question that's come in. The trivial benefit limit of £50, is it an annual or is it per expense?
It's per expense, although there is a note of caution perhaps to sound there, because the HMRC do sort of say that, you know, if you have a little chain of benefits which can be linked together, then that is indeed what they might do. So if you've got in the habit of providing, you know, a singular type of benefit on a regular basis, there's always the possibility HMRC might put all those £50 together and say that they don't qualify. But things which are quite, you know, distinctly different and what have you, you could potentially apply £50 to each one.
Okay, great, thank you. And John, another one for you as well. The question reads, on entertaining, is the cost per head allowance based on total staff based who are invited or who attends? For example, if the Christmas party was open to 100 staff but only 70 attended, is the allowance apportioned in any way?
It's those that attend. I don't think HMRC, you know, when it comes to record keeping, of course, generally speaking, you'd probably provide them with a copy of the invoice from the hotel or whatever it is, sort of showing that you've got an event for, I don't know, 150 or what have you, and even though 100 might only have turned up, I suspect that in practice the inquiry wouldn't go any further than that. But it is those that attend.
Great, thank you. Thanks for the questions that came in. There was one other question here just around checking whether the slides will be made available. Yes, they'll be shared after we've closed the event, so they'll come through to you as well. Dawn, I have a question for you on R&D. So thanks, Dawn. So in your section, you talked about HMRC's R&D Disclosure Facility for being able to correct errors, mistakes, and to fundamentally address non-compliance. But what are the common mistakes that we're seeing in R&D claims at the moment?
Well, it's interesting because I think HMRC's view of that and probably business and the profession's view of that might be slightly different. What we're seeing from HMRC is that they don't think some of the claims are qualifying, so they're denying the whole claim. So it's whether there actually is an advancement in science or technology as a result of the work being undertaken. So it's a dispute about what is fundamentally covered by the relief or not. Other aspects include errors around which type of scheme has been used. So most people will be aware historically there's been the RDEC scheme and the SME scheme. Some businesses have claimed under the wrong scheme. What is included as if you get over the line of agreeing that it's research and development for tax purposes, then it's what is included in that qualifying expenditure, so the percentages of people's time. And then an age-old issue with inquiries is evidence. So there has been issues in supporting claims where either they haven't been presented very well or the business has not been explained very well. And then when HMRC checks it, the evidence for the expenditure is not there. So they're probably the main areas, Karen.
Great, thank you very, very much. There is one more question that's come in regarding the cupcake question. John, I'm going to ask if you could please quickly cover that one actually just before we move on.
Yeah, sure.
So the question is, regarding the cupcake question, if you change the dynamic of the question from buying the team to buying all staff in the company a cupcake, would that become allowable for tax relief? I like the thinking there.
Yeah, I think the difficulty you have is that probably the answer is no, Karen, because in practice there's still an expectation on the part of the recipients that they might get it. It's the fact that it's every Friday which is the issue.
Great, thank you very much. Thank you so much for all your questions. It may be that there's one or two more that come through, but I think if we just move on to our final slides of the session, please. Great, thank you very, very much. So on this slide, we just wanted to share details of a few upcoming events. Early February, we have part 2 of our Navigating the Changing Landscape of Tax Governance, Risk and Compliance webinar that is exploring elements of a successful tax function from structure and processes to technology and talent. That, like I say, that's part 2 of the earlier webinar that we had on what good looks like in terms of being a large business in December. Then a little later in February, we have the next webinar in our supply chain resilience series, which is focusing on how technology and data can transform operations and create value for your organization. And then that will be followed by later in February, a special edition of our On Top of Tax webinar series focusing on employer year-end reporting and compliance, where our employment taxes team will be running a panel discussion on year-end reporting changes and where things can easily go wrong. And that is then followed early March by a Pillar 2 advisory webinar, where again our specialist teams will be covering the practical impacts of Pillar 2 on transactions, restructuring and tax incentives, and so on. Next slide, please. So just sharing here now a few final details on how you can stay up to date. You can sign up to our monthly On Top of Tax newsletter to get a monthly roundup of the most important tax updates from BDO, plus invitations to our webinar series and upcoming events. And for quick updates and insights, you can also join, if you wish to, our On Top of Tax group on LinkedIn, where we share quite timely, real-time BDO tax news. And just linking back to Matthew's section there on customs, excise and international trade, if you feel you are struggling to obtain good data and analyse your customs and international trade data, we do have a customs data analytic tool, which is available on our BDO store to help you minimise your tax risk and be compliant. If you have any questions around that, or if you think it could be helpful for your business, please do speak to your usual BDO contact, or head to the BDO store, or head to Matthew, who you have heard from during this session. I don't see any further questions, so I'll draw this session to a close. Just like to say thank you again for joining us, and look forward to you joining us at the next event in February. Many thanks.